Sell in May and go away did not work these past several months. It was a spectacularly strong summer performance for the stock market. The S&P was up some 7.7%, something in that neighborhood. There was a clear divergence between growth and value stocks. Growth stocks were driving the increase, and there was something of a concentration in terms of index returns, because the largest stocks such as Apple and Amazon tended to be the best performing stocks. One of the things that's interesting about the performance of the stock market over the summer is that all of the trade tensions and the tariff talk has had very little impact to date. And we have had a number of companies make specific comments about rising costs and the impact that that's having on their business. Ford in particular has been pretty vocal about the impact of the tariffs on their costs and measures that they have to take in response to that. And yet, it has not really served as a brake on the performance of the stock market. At least it didn't serve as a brake during the third quarter.
Well, after months of back and forth with negotiations between Mexico and Canada and the United States, and threats by the Trump administration of even pulling out of NAFTA, we seem to have ironed out an agreement at the end of the quarter, subject to ratification by Congress, for a new trade deal. Incremental changes from NAFTA, but it's a big improvement, in my opinion, from the uncertainty and the more extreme types of outcomes that were possible. And so I think that was good news.
The end of the third quarter of 2018 also marked the 8th time the Federal Reserve raised interest rates in the last 11 months. We're coming on nearing the end, potentially, of their rate increases. Even though that process may be coming to an end, we're being extra vigilant.
There has been concern for quite some time that as the Federal Reserve winds down its quantitative easing and its balance sheet shrinks, that will be pulling money out of the economy and eliminate a source of liquidity for asset investment and for driving the prices of assets higher. And we have seen a significant decline in the size of the Federal Reserve balance sheet, and yet, to date, that hasn't had an effect on stock market performance in the United States.
This is what's causing some of the pressure in the emerging markets, in conjunction with higher oil prices. We're having essentially a trifecta: higher interest rates, a strong dollar, and high oil prices, all making it a little challenging for some of the emerging market countries.
Overall, we'd like to see the Fed slow down a bit and be a little bit more relaxed in allowing maybe wage growth, maybe inflation to tick up a little bit more before doing more with rates to put on the brakes for the economy.
Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information about the Amana Funds and a current prospectus or summary prospectus, please visit www.amanafunds.com or call toll-free 1-888-732-6262. Please read the prospectus or summary prospectus carefully before investing. Performance data quoted represents past performance, which is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than the original cost. Current performance may be higher or lower than performance data quoted. Standardized returns current to the most recent month end can be obtained by visiting www.amanafunds.com or by calling toll-free 1-888-732-6262.